Welcome to RBC's Markets in Motion podcast, recorded September 29th, 2025. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we review what clients were most interested in talking about on our trip to the UK last week, which included differences between U.S. and UK investor sentiment, valuations, flows, and sectors. Second, we recap the macro tidbits we picked up from last week's S&P 500 earnings calls, where the auto-related names had a negative tone, our takeaways from the Duke CFO survey, optimism about their own companies moved up slightly, and what we learned from our review of how stocks have traded around government shutdowns in the past. If you'd like to hear more, here's another 6 minutes. Let's start with takeaway number 1, issues in focus on our trip to the UK. We spent several days last week seeing institutional investors in the UK who had an interest in U.S. equities. Here's a rundown of what they were most interested in talking about and our replies. First off, differences in U.S. and UK investor sentiment. We spent 3 days seeing investors in London, and right from the beginning, it was clear that the state of U.S. investor sentiment and how it compared to investors in the UK was of keen interest. From the beginning, UK investors sounded cautious, both generally and on the U.S. in particular, which stood in contrast to the more constructive tone we'd started to see in our New York City meetings in September. In our discussions on the state of U.S. investor sentiment, we pointed out how net bulls in the weekly AAII survey had fallen sharply in August and September, at least at the start of September, but had started to move back up in the middle of the month. We noted that even though AAII is a retail investor survey, we thought its trends were still a good representation of the shift in tone we'd been hearing among institutional investors in the U.S. in recent weeks. By the end of our UK trip, we started to point out that some of our U.S. clients had thought our recently introduced 7,100 second half 2026 S&P price target was too low, but that a few of our UK clients had actually told us that they thought it was too high. Importantly, while UK investors sounded cautious last week, they didn't sound nearly as negative as they had the last time we visited the city in December of 2024. Back then, we described the tone as alarmed. Today, we think cautious or concerned is a much better word. Second, valuation concerns in the UK were clear. In most of our UK meetings, the investors we spoke with proactively brought up the problem of elevated valuations in the US. As a result, we spent some time highlighting our charts on the bottom-up market cap-weighted S&P 500 FY2 PE, the equal-weighted FY2 PE of the top 10 market cap names in the index, and the FY2 PEs of the NASDAQ 100, both cap and equal-weighted, which have all been stalling near post-tech bubble highs. These charts have contributed to our own concerns about the possibility of a short-term pullback in the S&P 500 before year-end. By illustrating how the workhorses of the U.S. equity market, i.e. those with the best fundamental narrative, have been priced for perfection, these charts have also helped us understand why angst about the megacap growth trade and AI theme have kept popping up since mid-August, resulting in a few down days in the S&P 500 of late. Investors we spoke with in London also expressed some concerns about whether the AI trade had gotten a bit ahead of itself. In these discussions, we noted that through 2Q25, S&P 500 CapEx growth was close to peak levels, and that we'll be keeping a close eye on what companies say about AI-related spending in the upcoming reporting season. In the last one, we didn't see anything in the AI discussions to cause us to think companies might be pulling back. The third topic in the UK was geographical flows. Here we highlighted our weekly charts that track flows into and out of different countries and regions, along with those that parse these flows by fund domicile. These charts have been telling us that both U.S. and non-U.S. domiciled equity funds, a proxy for U.S. and non-U.S. investors, have both generally seen flows to the U.S. deteriorate in recent months, and that the push into Europe and Germany on the equity fund side seen earlier this summer faded over the summer. We also noted that the flow data indicated that equity fund investors hadn't settled on a new area of focus. In recent months, inflows or improving trends to various regions and countries have ended up being short-lived. Where we have seen a sustained interest is into global ex-U.S. equity funds, though that has also lost some momentum in recent updates. Interestingly, last week's EPFR update, which we saw after our trip was over, highlighted how Western European equity flows have improved slightly on an overall basis and for funds domiciled both within and outside the U.S. Flows to non-U.S. domiciled U.S. equity funds also picked up last week. The fourth topic in the UK was sectors. Whenever we go to the UK, as well as continental Europe, sector selection is usually of interest. This trip was no different. Healthcare was one where we received a number of questions. In part, we think this is because the sector looks attractive on our valuation work, while earnings and sales revisions have also been quite strong. In these discussions, we pointed out that most industries within the sector do look appealing on our valuation and revisions work, that the sector has benefited from the weaker dollar, and that flows to global developed market healthcare funds were recently showing an improving trend. As for why we're staying on the sidelines with a market weight stance, we pointed out that policy risk ranked higher than most other sectors in our mid-year RBC Analyst Outlook survey. We also noted we've been overweight this sector in the past due to a similar setup with valuations, revisions, and flows, but that the flows have had difficulty sustaining a strong uptrend. Interestingly, in the latest funds flow update last week, which came out after our meetings, we could see evidence in the data of another negative shift in flows. Now let's move on to takeaway number 2, other things that jumped out. First off, we're feeling a little carsick. The handful of S&P 500 companies that reported last week provided a few interesting details on the macro, though the signals were mixed. One tech name downplayed the relevance of H-1B visas to their workforce. A services company on the industrial side said they had not seen any significant changes in demand between 1 and 2Q. One tech company highlighted robust and broadening data center demand, while another alluded to choppy end markets. On the consumer side, the big retailer that reported frankly didn't provide much color on the health of their consumers, aside noting from the fact that they remain choiceful. However, they did provide a deep dive into their multi-pronged tariff mitigation strategies, which has included working with suppliers to find offsets, sourcing from different countries and local production, and absorbing costs themselves while offsetting those costs to protect the member by improving efficiency, lowering waste and spoilage, and those kinds of things. Overall, the auto-related names had a more negative tone than the other companies that reported. One made various comments pointing to the impact of tariffs starting to show up in pricing, along with pressure on the lower-end consumer. After missing expectations, another auto-related name noted that while hard to quantify, we do believe there was a pull forward of demand in the first quarter. Next up, a C-sweetener. The Duke CFO survey, one of our favorite sets of soft data, came out last week, prompting us to update our batch of C-suite sentiment charts. In the Duke CFO survey, which was conducted late August and early September, optimism about their own companies picked up in 3Q, but remained below prior highs. We think this reflects the tone we heard in the last reporting season. A similar uptick was seen in the 3Q25 Business Roundtable and Conference Board CEO confidence surveys that had previously come out. Trade and tariffs remain the most pressing concern in the Duke CFO survey, though overall levels of angst on the issue did ease. Meanwhile, concerns about monetary policy rose a bit, taking that issue to second place. Though a clear majority said there had not been an impact, it was interesting to see that 21 to 25% still said their hiring or CapEx plans had decreased due to changes in tariff policies. And finally, just in case, 2025 government shutdown expectations moved up in betting markets last week as the S&P 500 stumbled. We frankly haven't gotten many questions on the implications for stocks on this issue, and none in London. Still, we've taken a fresh look at how the S&P 500 has traded around shutdown since the 1970s. Moves have been directionally mixed and mostly mild during the actual shutdowns. This doesn't tell the full story, though, and so we took a closer look by decade at the S&P 500 drops that occurred near shutdowns. Some of these, in the 70s, the early 90s, and 2018, occurred against the backdrop of very sizable drawdowns. But the shutdown wasn't the main thing impacting stocks then, and shutdowns also helped mark the end of 2018's pullbacks. Other shutdown-adjacent pullbacks, those in the 80s, the late 90s, and the early 2010s, were mild, in the minus 1.5 to minus 4.5% range. Our bottom line, we've been concerned about a period of digestion in stocks before year-end, but shutdown fears are not at the top of our list of worries given the history. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.